Good morning, and thank you for joining Odyssean Investment Trust's update call this morning. Before I hand over to the portfolio managers, Stuart, Widdowson and Ed Wielechowski, just a few admin points. You'll notice three icons at the foot of your Zoom screens: chat, raise hand, and Q&A. Should you wish to ask a question at any point, please click on the Q&A button and submit the question, and we will look to answer at the close of the formal presentation. Odyssean Investment Trust has now grown to 170 million market cap through a combination of strong performance and secondary share issuance. The team has posted 70% share price return over the past 3 years, and these returns have been achieved with a long-term average cash balance of 7%. Since inception, the team has seen over 7 completed or pending bids for portfolio companies and a further 5 approaches which have been made public. This, we feel, is especially impressive, given that the team only holds between 15 to 20 stocks at any one time. With that, I will now hand over to Stuart and Ed.
Thank you, David, and good morning, everybody, and welcome to our second quarter webinar. From the attendee list, it looks like many of you are familiar with OIT and how we invest, so let's get straight into an update. Whilst Q2 was another difficult quarter for many investors, it was very pleasing to see the trust deliver a further outperformance and differentiated performance to the broader market. Now, as you're familiar with, our objective is not to beat the market. Our objective is to try and deliver positive returns over the long term. We're not absolute return investors, so we don't short stocks or markets or use derivatives, but we really do focus on fundamentals and specific characteristics of each investment we're looking at. And we're big believers that valuation does matter. And it's very interesting to note over the last few years, we think a lot of the UK small cap market until August last year was really driven by price and earnings momentum, and valuation didn't matter. Our investment strategy doesn't work all the time. We do tend to find when the market's very bullish, we can slightly lag a bit, particularly when markets are frothy and valuations are high. And we tend to get most of our performance in sideways markets and markets that are quite tough. And it's really great for Ed and Ian and I to see the trust delivering what we set out to deliver when we IPO'd in May 2018. Cash balance over the period is quite low at 2%. This reflects 2 things. Firstly, the conviction that Ed and I had in the portfolio, and we've gone on record to say we felt quite capital constrained given what we saw as valuation in the portfolio, but also new opportunities in the market. It also reflects the fact that a number of our companies attracted a bid interest over the period, which was crystallized over in mid-July. Before we move on to what happened, of course, it's worth dwelling again on the long term. Ed and I are really focused on what's happening quarter to quarter. We're really here to deliver, we believe, attractive long-term compounding returns for our shareholders. And I think it's really interesting to note, given the performance particularly over the last 9 months, we don't believe our strategy is dependent on ever re-rating markets or QE to deliver good and attractive returns to clients. We're really focused on special situations, companies going through change, and extreme valuation anomalies in what we perceive to be good businesses with good potential. We'll talk a bit later about general equity markets, but it's really interesting to see the scale of the derating, particularly of US equities over the last period since we've been looking at this. And our view generally at the moment is that with QE, all equities have been sold down, even the ones that were cheap to begin with. So from this point forward, we think from a perspective of the part of the market we work in, we do believe that pretty interesting opportunities to make money for people over the next 3 years. And on top of that, on a stock by stock level, we continue to see really interesting upside, which we can talk through. However, no investment style works across every market condition, every month or every quarter. We're not really focused on that. What we're focused on is still, how do we think we can make money over the next 3 to 5 years from everything we own in the portfolio? Now, we either think that's going to be delivered potentially by companies being recognised for what they're delivering and rated properly, or alternative, as David talked about, M&A. Ed's going to talk through a bit about the drivers of performance specific in Q2, as well as the constitution of the portfolio today.
Great. Thanks, Stuart, and thank you everyone for your time today. Pleasure to give you an update on the quarter. And this page, as Stuart says, sets out the key drivers, both positive and negative, for performance of the portfolio through the quarter. I guess let's start with the good news, I guess, on the positive side. I guess the biggest news from the portfolio during the quarter was around Euromoney, which was on the receiving end of a bid from private equity houses Epirus and Astor at a valuation of 1461p per share. Those of you who've listened to a few of our webinars and talked about the portfolio a few times will probably not be surprised to hear that we aren't surprised to see PE interest in Euromoney. The business is a B2B media company, which is a sector which has attracted a lot of interest both from private equity and trade buyers in recent years. And our view of Euromoney was always that the market was overlooking the sum of the parts, the various components of the business, particularly significant value tied up in its price reporting agency, Fast Market business. So particularly interesting for us was that unusually, in fact, the only example I can think of on the top of my head, this is an example of a private equity consortium that's come in and explicitly said they're going to break the target up into two separate pieces, with one private equity house taking one part, the other taking the second, which in a way kind of underpins and proves out our view that there was certainly value in some of the parts of Euromoney that was underappreciated by the market. So look, it's a bid which we're always pleased to see, we never rely on, and for a business where we always thought we had a well-protected downside, it offers a pretty decent return on our investment and a decent outcome. Next on the list is Curtis Bank. Curtis Bank's actually wasn't much news flow around the business during the period, but for those of you who know the business, it's a SIPP provider and is a beneficiary of rising interest rates. It has a large cash balance, which it makes a small turn on. And as rates rise, that should help support profits going forward. So that obviously helps the story to some piece. Perhaps more interesting and more exciting in many ways. And for those of you who are eagle-eyed, you will have seen there's been a certain amount of board change at Curtis Banks over recent months. And as a large shareholder, we've been involved and supportive of those changes. We've seen a new chairman and a new NED being installed recently. Now, our thesis around Curtis was always that this is a good platform, but perhaps could be doing better. And we see significant scope for it to drive up both margins and then extract more value from those long-term SIPP client relationships it's got. And we see that the change of board is possibly the start an indication of realizing some of that value, either as a standalone business or maybe as part of a larger group over time. So they're really excited by what can come from Curtis going forward. Last one, NCC, a business which we've been in for a while. Shares had been weak coming into the quarter as people were concerned about the impact of wage inflation in the cybersecurity consulting part of the business. So particularly pleasing to see that their strong H2 trading update came out and flagged that they've been able to grow gross margins in that part of the business. We think that reflects a lot of the good work that's been done at NCC over the number of years around its ability to share work across its global footprint, to make use of low-cost jurisdictions, drive up utilization of its headcount. But more importantly, they've been raising prices, and that is more than capable of offsetting any wage inflation they've been seeing, it seems. So strong performance by the group, and really interesting actually to note that they announced a change of CEO shortly after those results. A change that we're positive on. Interesting, because it's not often you see a business change. A CEO actually was performing pretty well for a different candidate, but in this case, I think it reflects a change in where NCC is in its life cycle. So it's been through some of the self-help around building an operating platform. The next leg is to drive top-line growth, particularly around that cybersecurity consulting business. And the CEO they bring in has got a strong track record there. So we're pretty exciting to see that shift, if you like, of where it is in the journey and what it might mean for the stock going forward. On the negative side, got to talk about the negative ones as well. All three, Xara, Elementis and Flowtech, some common themes. All three are more exposed to the industrial markets, industrial end markets, and some common performance characteristics across all three. All three have broadly traded in line with expectations, delivered updates which held full year expectations, all kind of reporting similar themes around demand remains strong, order books remain pretty robust, and all three are market leaders and are raising prices to offset inflation. So actually nothing fundamentally of an issue in the trading updates of all three. And all three are also delivering on their self-help objectives. So ZAR, new product pipelines going well, rebuilding their go-to-market channel. Elementis, success in building out their new lower-cost Indian facility. And also notably, they flagged they're doing a strategic review of their chromium division, which we would see as an interesting story if they manage to successfully exit. And Flowtech, really positive to see them finally launch their new online digital platform, which we think will help them gain share in a market which is pretty unsophisticated on the digital side of things. So all three, robust trading, decent kind of operational performance, but caught up, we feel, in the wider sell-off of industrial names, which in this case we feel is a little bit unfair, if you like, on market leaders driving self-help and recovering inflation through price rises. So we remain positive on what all three can deliver. If you move on to the actual makeup of the portfolio on the next slide, we always like to give you a few pie charts to give a flavour for the structure of the portfolio. On the left here, we show the sectoral split. A few things to point out. Industrials remains the largest sector exposure at the moment. We actually built up a few of the positions in those names I just mentioned, which were weaker during the quarter where we saw opportunity. Other changes during the period, TMT obviously grew materially, largely as a result of the Euromoney bid, scaling the way to that position. I'd also flag that we built our position in healthcare through increasing our exposure to Spire during the period. Net cash fallen a bit % in the period, a little bit lower than the average, as Stuart mentioned, reflects that we're really quite excited by what we've got in the portfolio and other opportunities we've seen. On the market cap size range, we've said this before, but our core focus is in the 100 million to 1 billion market cap size range, and the bulk of our exposure, you'll see about 70% is in that market cap range. I'd flag, we do occasionally drift above that. You see we have a chunk of exposure in above a billion. That's largely Euromoney, where the bid has pushed it above that size range. We've always flagged that our sweet spot is probably more towards the 200 to 500 million pound mark at time of investment. And the weighted average market caps of the portfolio are 450 to 550, kind of reflect that position. But I would say what's been interesting for us, I guess, and Euromoney is an example of this, is that we are finding opportunities at the larger end of the size range we look at, where the characteristics are similar to those we find at the smaller end, and we find businesses which have perhaps poor liquidity, a poorly understood story, and a significant valuation anomaly. So we will stretch to the top end or the low end of the range where we find opportunities and are happy to do so. Remain disciplined, remain focused on our core, but you're finding opportunities up and down the size range. And I'll pass back to Stuart for a bit more on the portfolio makeup.
Thanks, Ed. One of the things we thought was really interesting about Euromoney was, as Ed said, there was a sum of parts argument, but it was another classic example of a UK listed company that is actually very international. In fact, it delivers more than 70% of its revenues in US dollar. And from what we understand, at least 90% of its profits from US dollar. And yet it's perceived as a UK small and mid cap. And over again, we talk to people and say, look, the UK, investing in UK small companies is not investing in the UK economy. So don't worry about the cost of living crisis and consumers being tough when you're thinking about investing in small companies. Now, if you invest in the index, that might be the case. As you can see on the right-hand side, the average small company delivers about 63% of its revenues from the UK. In comparison, if you look on the right, at the left-hand side, our portfolio delivers about only 35% of its revenue from the UK. And we're much more dependent as a portfolio on different geographies and different niches. And this is in part because we really like investing in these niche market leaders. The exposure to the UK has gone up a bit over the period. It's partially due to the performance of Curtis Banks and also due to us putting more money into Spire, as Ed said. Now, we think those companies, they're not Me Too businesses. In the case of Spire, it is the market leader in private hospitals outside the UK, outside the M25. It's almost a local monopoly. No one is going to rationally build a private hospital next to a Spire hospital. The economics just do not work. So where we do have UK exposure, we're looking for particular businesses with particular attributes that we think are going to be defensive, even if the UK economy gets quite tough. We're going to talk through a bit more about the underlying portfolio companies now in terms of themes. And we have started to do this because there are a small number of themes that do encapsulate quite a lot of the portfolio by NAV. The first one is cyclical industrials, and Ed talked about this a bit earlier. The biggest two positions here are Elementis and Flowtech, which we've talked a bit about before. We've also added 2 new positions in this category over the last 4 months. And these companies are currently total hold positions at about 2% of the NAV each. They're companies we know very, very well. We've known them for more than 20 years, never invested in them before. But the reason we've invested in these companies is not because we think the macro is going to be fantastic. We don't think it's going to be dreadful. But these companies are proven market leaders within niches around the world. They have relative market shares of 4 to 9 times in their categories. That means they're between 4 and 9 times bigger than the next guy. And we think that's really attractive because they'll be in a very strong position to pass on price increases as they come through. Neither of them have any particular supply dependence, and neither of them have any particular customer dependence either. So they're in a very, very strong part of their supply chain. But moreover, actually, they're in categories that we believe will grow above GDP by between 3 and 6%. So these are growth companies in drag almost that the market just doesn't want. And we basically paid about 11 to 12 times forward earnings for these companies. They've got no balance sheet issues. They're very modestly geared. And we don't think the earnings expectations are that demanding for them at all. In fact, we think on a 3-year view, the earnings power is materially above the current earnings level. So we believe the sector in general has just been thrown, it's been almost thrown out of the bathwater, the concerns. What's really interesting to note actually over the last few weeks is a number of companies in this sector, not specifically ones we own because they haven't reported yet. Really good example, Vesuvius is well known as a very, very cyclical industrial. The shares have rallied more than 20% since the bottom a few weeks ago, and they've come out with a pretty robust trading statement of results over the next week. So we think there's real value in this segment of the portfolio that we have at the moment. Macro will put up with, on a 3 to 5 year view, we are very, very confident we're going to get our target returns out of these companies.
The next category to talk about is B2B media, where Euromoney and Wilmington are our key plays. Euromoney, subject to a bid, may go away, but we're still quite positive on the theme here. We actually started building, I guess, our weighting in the B2B media assets about 12 months ago. And the story then is very, very similar to the story now, is that these assets are fundamentally high quality business models. You provide data to corporate clients, you provide events, you provide training, which generates a significant amount of recurring revenue, which is a good place to be in uncertain times. You typically are strong positions in your market, able to pass on inflation, have attractive working capital dynamics that you bill up front, a lot of things that you would like about these business models. Then we were always positive on COVID not being the death of in-person training and in-person events, and increasingly over time we started to see that come through with recent sets of results from both Euromoney and Wilmington, but also other events players in the market such as Hive. So there's that kicker as COVID reopening continues that these businesses are well placed to drive a strong recovery in earnings, and that's now starting to be being seen. And then I guess what really got us excited about these businesses are 2 things. In both Euromoney and in Wilmington's case, the COVID crisis actually has accelerated delivery of a self-help program. In both cases, businesses were reasonably conglomerate in structure, a significant opportunity to bring together back office functions, bring together platforms for delivery of their content, for example, drive efficiencies and digitalize the business to deliver more content over the internet, which has obvious impacts around scalability and margin profile of these businesses. And both really use the COVID period to deliver on some of that investments, the benefits of which we think will start to be coming through now. Plus, we saw both as trading on significant sum of the past discount, which is, I guess, been proven out by the Euromoney bid. So we remain very positive on the B2B media story. Sorry to see Euromoney go, but Wilmington, I think, now is in a very interesting point in its cycle. It's had its recent results announced actually yesterday. The organic growth is starting to come through, not only through the recovery in events, but also for the benefits of their investment in the platform. That's flowing through to margins in a business with net cash balance sheet, which can go out and do interesting M&A while others in the sector may be a bit more capital constrained. and we continue to see that businesses trading at a discount to the various parts of the group. So remain positive on the story of the B2B media assets we'll have left going forward.
Thanks, Ed. The next category is B2B electronics. We've spoken a bit about these companies before, and it's worth saying these are not players in the macro cycle. Both these companies are long-term improvement stories after protracted periods of management self-harm over the last 10 years. And we think there's a lot to go in terms of improving the businesses, regaining market share, rebuilding gross and net margins, but also in categories that we think have got real tailwinds at the moment. The commonality between these businesses is they both have a very positive energy saving and ESG focus by the introduction of their technology. In the case of Dialight, I have real experience of this through the family. Putting in LED lighting in areas that require significant industrial lighting is a massive saver of energy, even before the recent energy went up. And if anything, this is pretty much a sweet spot for the company at the moment. Unless you think energy prices are going to fall materially over the next 12 months, this company should do really, really, really well. The management team have sorted out the supply chain, and we think, again, this company looks pretty vulnerable over the medium term to becoming part of a bigger company at the current valuation. It's trading about 0.8 times EV sales. It should make low to mid-teens margins, and it's probably worth, we think, potentially up to double the EV sales it's currently trading on. In terms of Xaar, those of you who've heard us before, we really like Xaar. The management team have done a fantastic job starting to repurpose almost trapped IP in the business to create a fantastic pipeline of new product launches, which is partway through, which we think will increase its addressable market by up to 7 times. We're very, very positive about this business. Virtually all the capex has been spent. They can quadruple production, we think, with very moderate capex in their existing facility, and that should be a significant driver of gross margin. On top of that, Ed and I went to see them again over the last quarter, and we basically found out through talking to them that they're implementing lean manufacturing. So that effectively, for those of you not familiar, that basically leads to a company looking at its manufacturing, seeing how they can basically increase the gross margin by being more efficient in the way things are manufactured around the factory, and really taking tough decisions about what they do internally in terms of process and what they might ask third parties. Now, we have experience of investing in electronics companies that have gone through this process. In our experience, it tends to add 200 to 300 points of gross margin. And on top of that, it tends to reduce inventory and working capital as well. So it's a great example, we think, of a potential slingshot of sales growth coming over the next 5 years, plus also specific activities to improve margin.
Thanks, Stu. And then cybersecurity, the next one on the list. I guess it's kind of a little bit more of a hidden theme that does account for maybe 11% of the NAV in the portfolio. The obvious story, or one here, is NCC. Its largest division is its cybersecurity assurance business, which effectively is a group of tame, very smart, very bright hackers who will go in and help you as a corporate identify weaknesses in your environment, protect it over time, monitor for future threats, etc., etc. Obviously, a market which is under increasing demand as the visibility and level of cyber hacks, data leaks, etc., is only going one way. The more hidden piece, I guess, is within Chemring. Within their sensors and information division, they have a business called Roke, which is effectively a cybersecurity consultant business playing into the defense and government sector. So think about, again, very smart people, very smart PhDs, helping to design counter electronic warfare solutions, defend against cyber threats to government infrastructure, etc. So stuff that is so men in black suits, they can't really tell you what it is, but increasingly they're giving more disclosure on that business, which is now somewhere about 80, 90 million of revenue, growing at double digits and delivering great margins. So we look across those two kind of core assets in the portfolio, and they're both playing into what is fundamentally an attractive market, growing at double digits. On the NCC side, very much corporate focus, as I say, driven by increased relevance of the cyber threat in the corporate environment. Chemring, cyber, electronic warfare, very much an area more defence budgets are going towards, and tragic events in Ukraine are driving budgets in one way in the defence space at the moment, and Roke is likely to benefit from increased money flowing there. So both businesses, good growth platforms, very strong IP and the skill sets they've got gives them pricing power and the ability to generate really interesting margins. And what's exciting for us is that we feel that the value of those cyber assets within NCC and within Chemring, is a little bit overlooked and masked by them being part of a larger corporate structure. So the sum of the parts argument here is pretty compelling. If either of those cyber assets were standalone, you can find reference peers, notably in the US, trading on multiples of revenue, which is significantly above what the parent group, if you like, Chemring and NCC are trading on today. And that's just not right or sustainable. So we feel at some point the market has to appreciate what that might look like, or give some values and credit for those assets, or there's going to be some kind of activity to crystallize that value over time. So we think both are really interesting growth stories with the value overlooked at the moment, underpinning future opportunity.
Thanks, Ed. And that neatly leads us on to our focus on special situations. We were with a client, on Tuesday, who basically said, look, we don't see you as growth or value, we see you as something else. And it was great to hear that, because that's really what Ed and I have been trying to achieve with this vehicle since we launched. Now, we're not looking for situations that are just dependent on the company re-rating with earnings and price momentum, or alternatively, the market just sentiment improving, shares getting more expensive. We're really focused on companies, as you can pick out from our narrative so far, that can help themselves, and where there's real opportunities to catalyze value through action. Your money, as Ed said, really interesting that basically the market, basically it's taken a third party to come in and break the business up. Again, Ed and I can't remember that ever happening before in a small mid-cap company with a consortium bid. Very difficult to pull off. I think the other thing on M&A is we don't pick stocks because we think they're going to get taken over. It's either an accelerator of return, or alternatively a parachute if things don't quite end up how we think. But we do think there is substantial scope for M&A going forward. Ned will talk about this in the next slide. Geographic arbitrage, again, Euromoney was a very good example. I should say these are the 6 things as examples we think our portfolio companies can make money out of, almost regardless of the economic environment. Geographic arbitrage, Euromoney was a fantastic example of that, where effectively we felt the company was trading at a discount because of the fact it was listed in the UK. You can see many of these other companies we think, are being penalised by being a UK equity. So we think there's a lot to go for here, and we don't expect these companies to deliver this overnight, but very confident on our ownership horizon of 3 to 5 years. There's lots of ways these companies can make money, and if it's not appreciated by the market, we wouldn't be surprised to see a few more of them end up in the hands of other owners.
Yeah, I think that's exactly right. So as Stu says, those self-help areas, synergies with trade buy, geographic arbitrage, some of the parts, undervalued growth. That's going to put the companies we back more in the M&A crosshairs. So we thought it was worth giving a little bit of an update on where we see the market for M&A at the moment, which is what this page is designed to do. So what are we seeing? So the chart on the top right shows that we are seeing signs that the level of M&A in small mid-cap UK companies is beginning to tick up, as you can see from the slow build of the bars on that chart. Now, it's by its nature very lumpy, so you can't always call a trend, but broadly, you're beginning to see more activity. And when we think about why that might be, there's a number of factors which would be supportive of that. Private equity funds remain very active. They've raised a lot of money in recent years and continue to do so. That dry powder sits on the shelf and needs to be spent effectively. Debt markets remain open. Yeah, we're hearing some stories that the bond markets might be harder, but at the small end of the market where we're looking, there are a lot of debt funds who've also raised a lot of money, and they're very active as well. And interest rates are rising, but historically, compared to historic rates, debt's still available and still not too expensive. Combine that with strong corporate balance sheets, there's a lot of money out there to fund M&A. And then obviously UK listed assets, sterling denominated assets, given the strength of the dollar in particular, are beginning to look quite attractive to overseas buyers, and we'll come on to where we've seen bids come from our portfolio. So a lot of things kind of driving why we see there's good kind of momentum behind M&A activity in the market at the moment. Then observations about our portfolio. I think we've mentioned this a number of times before. There aren't any poison pills in our portfolio. Everything is, in a sense, biddable, if you like. As Stuart says, not because we expect M&A to come along, we don't bank on it, but it could happen. And a few reference points here on the more obvious examples in our portfolio, which to flag is, Elementis, for example, was subject to a bid a year or so ago at a headline price of 160p from a US bidder. Since then, given exchange rates movements, a bid in like-for-like dollar terms would be much more in sterling, and the share price today is significantly below where that bid was. Similarly, Spire received a bid in 2021. Shares of today are below where that bid was. The bidder at the time was Ramsay Healthcare. And we flagged that since the most recent development for Ramsay is that they themselves are being subject to a bid from large private equity house KKR at a multiple significantly above what they proposed for Spire. So, new owner of a sensible buyer of Spire with deep pockets might come along at some point. So that's just a flavour of the kind of thing in the portfolio. There's opportunity we see. We don't plan for M&A, but it wouldn't be a surprise to see it coming along in 2022. And if we look at the activity in the portfolio since IPO on the next slide, which is something we've shown before, but we keep updated, just to give you, the flavour of the kind of deals we've been seeing. Obviously, there's been a fair amount of activity through the portfolio, but the things we draw out are when we've seen bidders, they are typically trade bidders and trade bidders from overseas. Where it has been private equity backed, it's typically private equity who are looking to either bolt into an existing asset or use the target as a platform to go and do future roll-up. Point of this being that these are acquirers who are not just bringing financial engineering, they're bringing synergies, they're bringing strategic value, and they've been paying for that. And that's demonstrated by the average completed bid premium being roughly 50% over recent deals, which I think goes to show that the process, or what we're trying to achieve through our investment process, is identify businesses which are fundamentally misvalued in our view by the market. And if that doesn't get corrected over time, M&A is either a parachute or an accelerant to our return. Not something that we build into our base case, not something we can expect or forecast, but there's been a lot of activity. The market is open at the moment, and we wouldn't be surprised if there's further activity to come during the year.
Thanks, Ed. And I think part of the reason for this is the wholesale derating of UK equities, not just in a relative basis to overall equities over the last 6 years, but particularly over the last 12 months or so. And you can see that from the chart on the left-hand side. It has been absolutely brutal, the derating that's been seen in AIM in particular. Now, we think it's a really interesting point from here, because unless earnings forecasts are substantially wrong, it does imply there's significant value in the market. And we'll come and talk about Quest in a few minutes, which is probably a long-term proxy for valuations than actually short-term forward earnings multiples. But I think the other thing to note here is since we've launched, our underlying market has derated. You can see from this chart from the IPO, our underlying market's derated substantially. And yet, and the market itself, measured by the NSCI plus AIM index, is up, I think, mid-single digits. And yet we've been able to deliver NAV per share returns of in the 60s. And then this is another example of why we're not dependent on markets re-rating and going up to make money. If that happens, it tends to be a tailwind. But our focus on companies that can create their own destiny, create their own value creation, and create their own improvement in value, we think it's almost as valuable as it's ever been in the market at the moment. If sentiment improves, fine, that's a catalyst, an additional kick on our returns. But from this point forward, we think the returns over the next 3 to 5 years look pretty interesting.
Thanks, Stuart. And kind of a little bit more on where we see value in the market. And this is analysis we quite like, and we keep refreshed over time. One of the tools we like to use is a tool called Quest, which is a cash flow modeling tool. Effectively, what it does is it takes market consensus forecasts for stocks and uses that to build a DCF, and then comes up with a fair value, a Quest fair value, if you like, for every stock. And we found out when we were having our recent update with the Quest team that you can actually aggregate all of the companies in a certain market to come up with a Quest fair value of a market at a point in time. And that's what we did, and that's what the data on this chart shows. The dark blue bars show how the Quest fair value today compares to the market value today, so is it a premium or a discount? And the light blue bars show how the Quest fair value premium or discount to the actual value of the market has averaged over the last 20 years. So what's interesting to us is we note here that the USA actually is an interesting outlier. When we first did this analysis back in January, the USA was actually trading with the US market was trading at a 70% premium to Quest fair value, which has obviously come down to 35% at the current level. So we're seeing a big devaluation in the US from what was a very elevated level. Now, we ascribe that to QE effectively driving money, if you like, into US equities, notably US large cap tech. And that sell-off since the start of the year has dragged the US down. But it's also dragged the rest of the equity markets around the world down to a certain degree. So when we do this analysis, we think it's particularly interesting is to look at where the UK is. So the UK today, according to Quest, is trading at a 25% discount to its Quest fair value. And that compares to an average over the last 20 years of trading at a 5% premium to its Quest fair value. So a significant delta to, if you like, the long run average based on a cash flow based valuation model, which I think is very interesting and indicative that there's value in the UK market. So having done that analysis, the question is, where does that value sit within the UK market, which is what we looked at next, and Stuart will take you through.
Thanks, Ed. So, we had a potential investor in on Tuesday who basically said, well, UK equities have been out of favour for such a long time now. They used to be 10% of the global, I think, benchmark. They're now 4%. And his perception was that almost the UK equities are interesting because they're so hated and so under-owned and so unloved. And you can see that definitely in the large caps on this slide here. But what's interesting is looking the comparison of valuations of where they're on Quest compared to their long-term ratings. And you can see here that there's substantial upside, probably be more upside if things normalise in small and mid caps. If you assume that UK small caps are trading on 26% discount to Quest today, and historically have traded on an average 37% premium to Quest over the last 20 years. And that's not just driven by the last 5 or 6 years of QE, that's an average, over that period. You would think that the biggest potential upside if markets and sentiment improve over the medium to long term is in the small cap area. And that's where we're focused. And that's where we're really seeing good opportunities at the moment. So to summarise, and this is very little change actually from the outlook we had in Q1. We've been around quite a long time. We think we've delivered a really good performance, not just over the last 12 years, but actually particularly since this trust has launched over the last 4.5 years, and we're quite close now to our 5-year track record. And it is differentiated performance. It's not growth, it's not value, it's something very, very different. And we're finding more and more people coming to us looking for something that's quite different to a standard growth or value fund. We remain positive on the prospects of the portfolio. I hope that's come through today. Absent M&A, we think these companies have the potential to be worth a lot more within the next 3 to 5 years as the self-help starts to be delivered. And M&A really is a kicker. We don't rule it out, we don't plan for it, but we would be quite surprised to not see the portfolio being a further beneficiary of M&A this year and next year. Everyone's focused on macro. We can't plan for it. It's something we put up with. But it is creating some really interesting new investment opportunities. And we've made, I think, Ed, 4 new investments over the last 4 months, 4 or 5 months, which is unusual. And we definitely feel as though we're capital constrained. For those of you that look at discounts in particular, we're very, very proud that our rating has remained so resilient since we've launched. I think the average discount is less than 1% since we've launched in a sector that has perennially suffered from a big discount. And we've proven our ability with the board to manage that volatility. Going forward, as some of you be aware, we have a redemption facility every 7th year. That means within the next two and a bit years, there's going to be a redemption event at NAV. So our view is we would hope and expect the NAV the discounts remain much less volatile than our peer group over the next 2 to 3 years. As David said, we're issuing shares. We do feel as though there's good opportunity to deploy capital. We have a block listing in situ. it's unlikely we'd ever do a big fundraising because of cash drag and the need to be forced to invest a lot of money quite quickly. But it's very encouraging to see drip issuance through the tap, and we definitely think we can put it to good use at the moment. Thanks very much, and we look forward to receiving your questions.
Thanks, Stuart. Thanks, Ed. So we've got a few questions here. The first one, some of which may involve a bit of repetition. What do you think about RWS after the strong drop in the share price?
Ed, do you want to take that?
Yeah, to be honest, the RWS is a position which we were reducing, and actually we used the strong drop in the share price to add to our position. I mean, fundamentally, we remain positive on the RWS story. It's in a market which is growing at 6 to 7% as the increase, as the volume of content that needs translation increases. And we think the combination with SDL has given RWS leading services expertise. So it's got a lot of translators in-house to do the translating for its customers, and a leading software platform, both to service its own internal volume, but also volume from clients, as well as software products which are leading in the market. So there's a lot to like about the business. And the share price sell-off was driven by a change in EU patent law, which we think was well known to the market, although when it finally crystallised, it was a bit of a surprise. And then also a new management team coming in and deciding to invest in the business to drive future growth. We think the team is credible. We think the growth potential of the business is material, and we think there's synergies to come through. And frankly, when we look at the business now, it's the first time it started appearing on buyout screens since we've been running OIT. And you saw the interest earlier in the year from Baring Private Equity Asia having a look at the business. We wouldn't be surprised there's other people looking at it at these current levels, because it's a growth cash generative business trading at a multiple which is below fair value in our mind. So we remain pretty positive on its position in the market, its ability to deliver growth going forward. And and if there's not the right price applied to it over time, there's always possibility of further M&A interest, which you've heard us talking about a lot today. So remain positive on the RWS story.
Thanks, Ed. There's another question here. Since your trust held up better in recent months, is it not better to buy the UK small cap funds that sold off by up to 40%? They've become much cheaper on a relative basis. If I can just nip in here before I open it up to you both, I think the key point here is that Odyssean isn't a typical UK small cap fund or strategy. It is very much complementary to more index-like strategies. There's many of them out there: BlackRock Smallers, Standard Life Smallers. And what we've increasingly seen is investors are holding this as something to complement those sorts of mainstream holdings as a special sits type vehicle, as both Stuart and Ed have alluded to in the call. So I'll open that up to you both now.
Well, I think, thanks, David. Look, I think Ed and I both agree with that. I think it's always worth thinking about where stocks have started from a fall rather than where they are now. Is Tesla cheap now? Having fallen 40%, don't know. I think it's very difficult. If you believe that we're going to go in a rampant QE phase, interest rates are going back to zero, growth might come back very, very strongly, but that's going to be dependent, amongst other things, on lots of things out of our control: monetary policy going back to unprecedented events, and also flows into UK equity growth funds, which are still pretty negative. The only corollary I can remember over the last 12 years was 2014, when growth funds saw reasonable outflows, and that went on for a period, I think, between 9 and 18 months. I think the real question is, it comes back to fundamentals. Do fundamentals still matter going forward? We think yes. We think there's a lot of ways we can make money out of our portfolio without having to take the risk that you're going to be your returns going to be delivered by a wholesale market re-rating.
I think the other element here is about time as well, is that I think we're very excited and positive on the value to come out of the portfolio over a kind of 3-5 year horizon. Over a few months, performance can vary compared to the wider market, but over that kind of time period, I think we're very excited by what the portfolio can deliver, and that would underpin an investment.
Thanks, Stuart. Thanks, Ed. Fallen angels, always to be avoided, or something that might be of interest?
Great question. So the three types of investments we historically like. self-help situations and undervalued companies. And that's where we felt the best risk reward was really leading up to August last year. And that, fortunately, that's been that's played out. Reasonably priced growth. Well, growth is becoming more reasonably priced sporadically. And then the last one, as you said, is the Fallen Angels. So these would have been a growth momentum investment that's just gone wrong. All the growth momentum investors head for the door, and the stock becomes quite cheap and has a lot of self-help. Typically, these are M&A plays where they've played the earnings momentum game and never integrated. Organic growth hasn't been as good as people see. They lose the rating to go and do M&A, and then the emperor's clothes are seen for what they are. There are some quite interesting situations we're looking at. We never say never. Fun enough, we were looking at Fevertree the other day. I think that's a great example of a fallen angel. My personal view is something like that's not quite cheap enough. You want to be investing in a company like that at a big discount to what you think the precedent M&A multiple is, what it's worth. Carbonated soft drinks businesses, it's a good example. I'm not sure we would invest in Fevertree, but they tend to make high teens margins. If you look at precedent companies around the world, you might put that on a 2.5 to 3 times EV sales multiple on a takeout. If we look at Fevertree, say, great, that's the takeout valuation. Let's take a 30 or 40% discount to that, and then that gets quite interesting for us. So very much case by case. We are looking at these situations, but we're not going to rush in.
Thank you. Will you look to vote against the Euromoney bid, or are you happy with the price?
Fantastic question. We haven't decided whether we'd vote for or against yet. I think it was a little bit skinny. I should say, look, we've made very good returns in Euromoney. We've made about 60% in a market that's fallen. We think it's close to fair value. But from what we understand beneath the surface, and I suspect we'll all see this in the detail of this when the documents come out, there's the potential of quite a lot of cash leakage and value leakage in breaking the business up, which is reflected in the price. So, I think it's okay, but a bit skinny. The question mark we always have is, what else can we do with the capital? And we think there's such compelling opportunities. Would we take 95p in the pound for Euromoney to go invest in a stock that we think is trading at 60p in the pound? Yeah, we would.
Execution appears to be very important in this market environment. How do you monitor and engage with the management teams, measure if what they've set is actually achievable?
Ed, do you want to take that?
Yeah, engagement always varies across every single investment. But then it's kind of broad picture. Before we invest, we like to be quite clear on a number of things. One of our mantras is invest in a good business which can be better. So before we invest, we like to identify the levers that are there that can make the business better, if you like, and that can vary from something as simple as better IR to tell the story to margin should be 1% higher. And then it's all about being clear on what the steps along the way are. So if it's something around margins, what are the key KPIs you're going to track to make sure the business is on track or not? And that allows you to have a much more informed discussion with management. So you're not just talking in the abstract about you're going to become a better business. It's you're going to become a better business because you're going to do A, B, and C. And reason we'll know it's happening is because we'll see these KPIs change. So we try and be quite granular and use that to structure our discussions. But in my mind, it's always about when you go in, be clear what's going to change and what's going to happen, and then be honest to yourself about monitoring whether that is being delivered over time. That helps us not fall in love with our stocks and be quite true as to whether things are performing, but also helps you have a more informed conversation with management teams. So I think it's all about clarity on the way in and honesty while you are in about whether things are going your way.
Great. Could you please elaborate on your involvement in the appointment of the new chairman at Curtis Banks?
Yeah. So it's our policy not to comment publicly on specific initiatives that we have investing in terms of engaging with portfolio companies. However, for those of you who are well honed in watching board changes, it's unusual to have 2 non-execs change at the same time, including the chairman.
Thanks, Stuart. I think that brings us to a close. So thank you to everyone for joining the call this morning. If you have any questions, please email distribution@frostro.com and we will get back to you as soon as possible. Thanks, Ed. Thanks, Stuart. And thanks again to everyone who joined.
Thanks, everybody. See you next time.